at the very end, talk briefly about the new tax deadline and what we know about it so far. More information is to come. And what we'd like you to do, or at least we're going to entertain questions at the end of each one of the sections. With a little luck, we'll hopefully answer the questions you have anyway while we're presenting, but if not, we'll gladly entertain any specific questions that you have for us. So as you may know, I think this is the fourth time we've chatted now about the Paycheck Protection Program. How many was it? Am I right? Okay, whatever it is. The funny thing is, the first time we talked about it, I thought it was a one-time deal, and little did I know that they would just keep changing things on us, and it would grow and become this big, messy, complicated thing. But if you think about it, though, it's what is it? It's an awesome SBA loan program that shells out money, normally 2.5 times the business's monthly payroll cost, without loan fees, no collateral, a mere 1% interest rate that only comes into play after you've had the money for many months. And then if you spend the money the right way, not only do you get a pass on the interest, you don't have to pay the principal back either. That's a pretty good deal. The program, PPP, was first closed last June 30th before it was extended to August 8th, and now it's back in two forms. The first draw, that's the original, has been reopened. Anyone eligible who couldn't previously get a PPP loan under that first draw can go back and do it again. So there are certain nonprofits or anyone else who couldn't do it can do it. And you might think, well, you heard about the second one. Why might you? In theory, it's possible to get both. And if we have time, we'll chat a little bit later about how you can possibly first get the first run and the second. Could be a challenge. But there's something I wanted to mention about the first one that's really important. It's called the necessity certification. And I want to read it exactly as it's worded. You are signing off that, quote, current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. That necessity certification is still there with the first one. They did do something weird to us a few times during the last run. What they did is they said, if your loan's under $2 million, we're not going to audit you unless maybe you give us some real obvious reason. But in general, we're not going to audit you on this. So that's something to keep in mind. But in theory, it is supposed to be something that is necessary for the business to have. So take that for whatever it's worth. What we're talking about in terms of this new draw, or the second draw, sometimes called PPP2 versus PPP1, if you used up all of the first draw funds for qualifying expenses, you had no more than 300 employees, and a drop in revenue of at least 25% in any quarter of 2020 when compared to the same quarter of 2019, you are eligible for a second draw or second round of PPP loans. You can use either your 2019 or 2020 payroll costs or income on Schedule C if you are a Schedule C filer to figure out how much loan you can get. And you can use the better of the two, 2019 or 2020 for second draw. For first draw, you have to use 2019. That same necessity question is on the PPP2 application, but you are deemed to have met that certification if you have that 25% drop in revenue. So pretty much everyone is there. There's an exception to it that I'm going to get to in a little bit that just came about in the last few weeks where you lose that deemed necessity exception. Um, a few weeks back, to our surprise, sole proprietors, single member LLC owners without employees have been given a change to the way that they calculate the loan amount. So it's normally taking your Schedule C net income, multiplying it by 2.5 and dividing it by 12 to get the loan amount. However, President Biden announced that Schedule C filers can use gross income on line 7 to much increase the smallest loans. In fact, some people had a net loss, or the loan amount was so small that they didn't care. It wasn't worth all the time and effort that it would take to do this. But now, if you're using the line 7 gross income amount, and that's after cost of goods sold, but before other operating expenses, you might get a much higher amount. It's still going to be capped for Schedule C filers at $20,833. That's $100,000 times 2.5 divided by 12. Here's the catcher, the catch, whatever we want to call it. The bad thing that comes with using this gross income method, you don't get that deemed passing of the necessity certification if you use the gross income method. So if you've got over $100,000 of net income and you're going to get 20,833 anyway, you definitely want to use the net method, because that way you are deemed to pass that necessity certification. I don't really fully understand why they did it this way, but it's just knowing the ins and outs. Go for the net income if it doesn't matter to you as regarding which amount. Okay, now here's another bad thing. If you already applied for PPP2 and you were approved by the SBA using the net method, unfortunately, under current rules, you cannot go back and redo it. If your application is with the SBA right now and they haven't approved of it, or leave the seminar now, leave this webinar, contact your banker and say, hey, pull it back. I want to redo it and get a higher amount using the gross method. It'll only take a few minutes to redo the application by changing one or two numbers, and you're done. And we still have time to do that. But again, it's important to do this before the SBA approves your loan, because while it may change, there's lobbying to get this to change. But under current rules, again, you're stuck if the SBA has already approved under the net method.
Steve, quick question.
Yeah.
If you are a Schedule C filer and have received unemployment, can you also apply for a PPP loan?
You can, yes. So let me see. Oh, I'm sorry. Excuse me. I left out one detail that's important. Not everyone that uses the gross income method loses out on passing the necessity certification. It's only those with gross receipts of $150,000 or more. So again, if let's say you got $130,000 or less, anything under 150, you still pass the necessity certification when using the gross receipts method. So excuse my not mentioning that right away. Now let's talk a little bit about the federal treatment of loan forgiveness, how this is treated on your tax return. On your federal tax return, a forgiven loan is completely tax-free and you can deduct the expenses the loan was used for. While hardly a straight path to get to that result, at least we're there. Now, Minnesota, on the other hand, that is not the case. For Minnesota right now, we haven't conformed to the federal law. And what we have to do is treat it as the cancellation of debt, and that's income in the year the loan was forgiven. So for example, if you got your original round one of PPP loan funding in July of 2020, received your official SBA forgiveness letter in January of 2021, you have taxable income for the amount of forgiveness on your 2021 tax return. There is currently a push to get Minnesota to conform. It looked like a few weeks back there was no chance of that happening. However, that was when we had a planned $1.3 billion projected deficit or something like that. I think now it's $1.6 billion projected surplus. So I'd say the chances are reasonable that we can push this through and it will be tax-free for Minnesota, but not currently. So stay tuned and we'll have to see what happens. Regarding the application for forgiveness, there is an interplay between PPP loans and the employee retention credit that Laurie is going to be talking about. To get full forgiveness, you need at least 60% of qualifying expenses to be for payroll, but you want to do your best to keep it at no more than 60%. And the reason is because if you're eligible for the employee retention credit, then you want as much of that payroll available for that credit. So again, we want to try and keep it limited to 60. How do we do that? We look at other qualifying expenditures that allow us to get full forgiveness, because that's key. We want full forgiveness of this PPP loan. What else can you spend it on to get to that 40% component? Employee retirement plan contributions, group health insurance premiums, that includes medical, disability, vision, dental, state and local taxes. And you can also use it for utilities, which includes electricity, gas, water, telephone, internet access, and recycling, all used in the business. And interestingly, gas includes driving your vehicle, gas in the car, used for business purposes. Mortgage interest on real and personal property. So most only think of what's on the mortgage for the real estate, but no, it actually, according to IRS guidance, counts for interest on equipment too. Even a car loan that's for a car used in the business will count for that interest. Rent paid on real property and personal property. So a car lease or other equipment leased for the business in addition to the space that your business is using. Unless, of course, it's rented from a related party. Then there's a limitation where you actually are limited only to the interest on a mortgage paid by the landlord. A very strange limitation, but unfortunately it's there and we have to abide by it. And there were some recent additions to that. For PPP loans not paid off or forgiven by December 27th of 2020, you can also include in that 40% business software to assist in operations of the company, like accounting software, payroll software, payment tracking software, cloud computing software. In addition, costs related to property damage from vandalism or looting resulting from public disturbances during 2020, and the cost of supplying goods essential to the operations that were under contract and for purchases that were known about prior to the covered period. And lastly, COVID-19 related protective items to help comply with federal local requirements, such as masks for yourself and your employees, disinfectant wipes, maybe you spent money to improve the ventilation system, or other expenditures that are made to make your work environment a healthier place during the pandemic. All of those are going to be qualifying expenditures too. Again, those last part just for loans not paid off or forgiven by December 27th. So let me think about
I
this.
have
sorry, go ahead.
two questions and a
Right.
5-minute warning. Are you ready for questions right now?
Yeah, no, that's fine. Let's open it up to those new questions.
Okay, the first one is PP1 forgiveness was forwarded to SBA on December 11th. So 90 days would mean March 11th of 21. Have not heard back from the SBA. Loan is under 1 million. Are there any thoughts as to why?
You should have. I would contact your banker and ask them to follow up with the SBA. Unfortunately, we can't talk as your CPA, or you can't talk to the SBA, but your banker can. So they should be able to find out what the holdup is. What often happens is the SBA will give to the banker and say, no, they're not qualified. We need this additional support to back up the loan request. and maybe somehow your banker didn't tell you about it. So definitely have your banker look into it.
I
Good
guess the
answer.
only other thing I would add is it's possible, I mean, the SBA has really been focused on, you know, the PPP, the second round. So it's possible that it's kind of gotten hung up in that quagmire where they're really trying to push through applications as opposed to, applications for loans as opposed to applications for forgiveness. So that to me is another possibility.
Okay. Second question, my year-to-date Schedule C shows a 29% decline in net income. Each quarter does not. Can I qualify for a second PPP loan?
You only have to have one quarter fall below that threshold. So you're good. No problem.
Okay, that's all the questions I have.
Well, if that's it, then the last thing I wanted to mention regarding wrapping it up was a couple very recent changes. The deadline for PPP2 and those who are going back to PPP1 for the first time was scheduled to be March 31st of this year, just the end of this month. However, it has now been extended to May 31st for getting your applications in, and the SBA gets an additional 30 days beyond that to approve. I still strongly suggest that you get your applications in right away at this point, but uh, at least now it's feasible. And because of this additional 60 days, for those who put in for PPP1 right away, or maybe if you do it right now and get things going right away, there's a shot that you could possibly still get PPP2 funding. So it may depend on your specific situation, but if you haven't done PPP1 before and you are eligible now, you probably want to go for that first and then see what happens if you might have a shot at PPP2 if you can get your funding in time quickly and use it. And just the other related thing, in the last few weeks, in addition to extending it, right before they extended it, they added $7.25 billion more to PPP funding to cover both the first and second round. So at this point, you should have ample time. There should be ample funds, but go to your banker right away. And if your banker is not able to help or not very helpful, then find another banker and, talk to your CPA if you don't know who to use. And there should be someone out there who right now can help you get this loan. That's all
Okay,
I've got, but we
very
can take
good.
more questions later if any additional come up.
One more quick, PPP2 is based on calendar quarter comparisons, correct?
No, it depends. Well, if your business uses a calendar quarter, yes. But if your business is on a fiscal year, then you would use those quarters.
Okay, and I did put in the chat, but Laurie and Steve will take a little bit of time at the end to talk about the new deadline change as well. All right, Laurie, I believe you're up. Thank you, Steve.
You're welcome.
Okay, so I'm going to talk about the employee retention credit, which has been around since the CARES Act, which was signed on March 27th of 2020. But a lot of us didn't pay too much attention to it because if you received a PPP loan, it was clear that you would not qualify for the employee retention credit. So I felt like at least most of my clients and sort of what, you heard from other firms was that anybody who could qualify for a PPP, they mostly did that because the thought was that that was going to be a better answer than the employee retention credit. So, not too many people that I knew of used that credit. But we had some law changes, surprise, surprise. And basically, the law at the end of December changed that. So the law that was signed into, it's called the Consolidated Appropriations Act, the CAA, changed that. That was signed on December 27th of 2020. Basically said you could qualify for the ERTC even if you did receive a PPP loan. So that really opened that credit up potentially to a lot more businesses. And the other thing that happened as part of that law change was that the credit was extended through June 30th of 2021 with some different rules, but extended into 2021. And then we had another law change in March, the American Rescue Plan, the ARPA, which became law on March 11th of 2021, which then further extended the ERTC through the end of 2021. So we got a whole lot more possible credits for businesses. So we'll go through first what you needed to do to qualify in 2020. And I think that's also partly why a lot of businesses didn't pay too much attention to it, because it is harder in 2020 to qualify, and the credit numbers are actually lower than the new credits in 2021. So for 2020, you had to have a more than 50% reduction in a quarter in your 2020 gross receipts per quarter compared to 2019, the same quarter. So things had to be pretty bad. And the other thing, well, another way to qualify, so it's an or, it's either that reduction in gross receipts or businesses whose operations were either partially or fully suspended due to government orders. So think about, restaurants, bars, salons, movie theaters. There was a whole bunch of businesses that were required to basically close their doors for a period of time. So there's no question that those businesses would qualify. That being said, again, even with the new change, you can't use the same wages that you need for PPP forgiveness to get the credit. So you have to be real careful or be thoughtful about that. So for 2021, that reduction in gross receipts has now gone down to more than 20%. So that's an easier threshold to meet. And the or is still there if you have a business that was either partially or fully suspended due to government orders due to COVID-19. So I think it's much easier for 2021 to get the credit. The other thing to be aware of is that the credit amounts are different. So in 2020, you could basically only end up with, 10,000 of wages per employee, which turned into a $5,000 per employee credit. That was the max for the year. 2021, basically you can look at the credit per quarter. It's again, the 10,000 of wages, but it's times 70%. So it's a $7,000 potential credit per quarter per employee. So it's a whole lot more money in 2021 than it was in 2020. So that's another reason, that I guess I would encourage everyone that, you really want to look at this to see if you can qualify. So 2020 obviously is payroll taxes, the filings have already happened. To get money back from 2020, it would require an amended 941, so a 941X. So that would be how you would do it for 2020. For 2021, you can do it through, basically the first quarter payroll tax filing, for March 31st, won't be due till April. So you can do it through there. There's also a way to apply in advance for the credit. And the other thing that you can do if you know you're going to qualify is that you can start, not remitting those taxes. You would just hang on to the money. And then when you file your first quarter payroll tax return, it gets worked into the calculation, and either you end up with some reduced amount you have to remit, or potentially there's no remittance of those employer payroll tax credits. So that's kind of in a nutshell those rules. I would say the other thing just to keep in mind is that, so now we have this interplay of PPP loans, the ERTC, potentially for businesses that qualified. We have these new grants that came into law. One of them was on the March 11th bill, which is the restaurant revitalization grant, which is going to give restaurants, bars, catering businesses, things like that, food trucks, an opportunity to apply with the SBA for these grants. But again, you can't double dip. So you have potentially that. And then we also have the shuttered venue operators grants, which came around in the December 27th, 2020 bill. But for basically, think movie theaters and theaters, things like that. So there's those couple of grants out there too. So there's a whole lot of stuff going on, which is partly why the push to extend the filing season. I mean, a lot of businesses and also the AICPA were really out there lobbying, writing letters to say, hey, we need more time to figure this all out. Plus you had the unemployment change, which we can talk about later, but there's just too much has changed in the last few months. We need to give businesses more time to really be thoughtful about, the best way to maximize these benefits. So, what qualifies for the credit? It's basically wages. And then you can also, if you pay for healthcare, that also would qualify as long as it's excludable from the employee's gross income, which for, most of your employees, so people that aren't business owners, that own the business, the health insurance that the employer pays is gonna qualify. So it's really a wage-based credit, but it includes the health insurance premiums. And the other thing to be aware of is that, again, with the double dipping, that you can't use those same wages if you potentially qualify for other wage-based credits. I would say the biggest ones that, there's a credit for veterans, there's the work opportunity tax credit, there's also the research credit. Those are credits that are based on wages. And then also the family leave and paid sick leave, if you potentially got those credits, then you can't use those same wages for the ERTC. So just be aware of that. The other thing to talk about is that if you haven't applied for PPP loan forgiveness yet, then the other expenses, which Steve kind of talked about, those have become a lot more important. For a period of time last year, we basically said, don't bother, you don't necessarily have to bother with digging out all your receipts if you can, qualify based on your wages. What's the harm in doing that? Well, who knew that at the end of December, they would come up with a law that basically does make it better to use your other expenses. So as of right now, they're still saying that if you already applied for forgiveness, you don't get to redo it. So if you applied for forgiveness, you had $100,000 loan, and you said on your application, I have $100,000 of wages, didn't give them any other expenses, then they're gonna basically say that you used 100,000 of wages for the PPP loan forgiveness. Therefore, those wages don't qualify for the for the ERTC. So if you've already applied, that's kind of the situation. If you haven't applied, again, it's good to be thoughtful about, I mean, I really think you're just gonna have to kind of model it out, but to be thinking about what other expenses do I have that qualify? We have the 40% cap on non-payroll costs, but they really expanded that. So I would, with that law change, adding, any kind of PPE expenses, things like that. It's just, there's a whole lot more expenses that qualify now. So I would definitely be looking at those. And the other thing just to keep in mind is that, so for payroll costs for the PPP loan forgiveness, you can include, there's other things that are considered payroll costs. As an example, retirement plan contributions. Well, those don't count for the ERTC. So you want to be thinking about putting those items in the application too, because the goal would be to use as little of qualified wages, wages that qualify for the ERTC. You want to use as little of that as you can. I mean, you still want to meet the 60%. So whatever you need to meet that to get the full forgiveness, but it's a whole different thought process than I think we had, up until the end of December. So it really, to me, requires some analysis, some thinking, and you also kind of have to look at, what quarters, if I do qualify for the credit, do I qualify for all quarters? What quarters do I qualify for? The wages that count for this credit are basically wages paid after March 12th of 2020. So March 13th of 2020 through the end of December 2021. That's the qualifying wages. So we're going to have these little gap periods that potentially, I think most people, PPP loans didn't start happening. I think the earliest was April. So you got a little period in there where you don't have an overlap. And then, you have a period probably after your covered period ends for the first PPP loan, and then second PPP loans didn't come in until January. So there's just a bunch of different gaps and different periods. So I would just be, thoughtful about that. The other thing to mention is that self-employed people, so if you basically have a Schedule C, you don't qualify for this credit. You also have to watch related parties, because if you're the owner and you employ your family members, most of their wages aren't going to qualify. Also, if you own more than 50%, your wages probably aren't going to qualify. We still need some clarification on that, because I think there's a whole question about, they talked specifically about C corporations, but I think there's a whole question about S corporations, and they've been asked for more guidance on that. And really the law pieces, the codes that Internal Revenue Code sections that they use for this provision really aren't, it's kind of what happens when you put a bill together fairly quickly and people aren't working through everything. That the code section they used is kind of it's not really the code section that you would think they would have used. So just be aware of that.
I've got some questions, Laurie, when you're ready.
Okay.
I don't think you've covered these. Is the EE retention credit for 2021 comparing gross receipts to 2020 or 2019?
You're comparing to 2019. Everything's going back to 2019, because basically the thought is, okay, that was the normal time. I mean, most of 2020 was not normal. So you're really kind of going back to a year where we're pre-COVID, is basically what we're
Okay.
comparing to.
Okay. Will most third-party providers file on client's behalf?
They will help you with the filings, but what I've heard, you're gonna have to have a conversation with them because they're gonna probably need your help with figuring out qualified wages. That's the feedback that I've gotten from, like, for example, like a ADP or a Paychecks, that, that you're gonna need to, hopefully they've already come to you, but if they haven't, then you're gonna wanna reach out to them. I mean, they will charge you for, if you need to go back to 2020 for amended payroll tax returns. What I've seen so far, I feel like what I saw they were charging to me didn't seem outrageous, but I believe you're gonna have to give them some input because they're probably not gonna know. Plus, with the whole, PPP piece, you're gonna have to tell them, what quarters for 2020, how much, so.
Okay, and then one last one, and then if there's any other questions coming in, send them their way. How does the auto forgiveness under 150K affect ERTC?
Well, I can answer that one if you'd like.
Sure.
So I believe what the person's referring to is how when you have less than $150,000 of gross receipts, you are deemed to have passed the necessity certification. That does not have any impact on whether you can get the ERTC, if I'm understanding the question correctly.
Yeah, I mean, I would think, so Steve's right that, we have this sort of automatic, almost automatic, and you still have to answer some questions and stuff, but if you're looking at the ERTC credit, then I think you need to look at, you're basically certifying on the forgiveness application that you have the underlying expenses. So you would need to look at your underlying expenses to see what you have. So as an example, if you, had 100,000 of payroll costs that you needed to get to that 150,000, I think my math is okay on that. And the rest was non-payroll, then you would be deemed to be using 100,000. Does that make sense to you, Steve?
Well, yeah, but I mean, I'm seeing the question, how does the auto forgiveness under 150 affect ERTC? There's no actual auto forgiveness. Forgiveness happens when you use the funds for qualifying expenditures. Now, if you're a sole proprietor, it so happens that you are deemed to have used it on yourself if you have no employees. So sole proprietor with no employees, it's actually pretty easy. You're good with not doing anything in particular. So there's really not an issue. But if you're also talking about the ERTC, you have to have employees because you can't get that as a sole proprietor. So that's why I'm not fully sure I'm understanding the question right.
Okay, because I think the 150K, you don't necessarily have to provide all the documentation. Is that, you still have to have the documentation, but you don't necessarily have to provide it to the bank. So perhaps that's what but you still, to get forgiveness, you still need the qualifying expenses. So you would need to look at what expenses you did have that qualify, would be my thought. And if the person wants to write back and.
Yeah, I'm not sure I'm understanding the question.
or speak out. Laurie, I also posted the link you asked me to post. Is there any comment on that?
Yeah, so that link is basically, it's some guidance. It's an IRS notice. It's some guidance that it relates only to 2020. We still need some more guidance for 2021, but I think, to me, what's helpful in that guidance is the questions and answers about what constitutes partial or full suspension, because that's going to be a key component for a number of businesses. I mean, like I said earlier, clearly restaurants and bars, you know, they had to reduce capacity. They had to be closed for a period of time. I mean, in Minnesota, we're still under reduced capacity. So those are easier. I think the harder ones are, you know, places that, so as an example, like if you were able to convert your business to teleworking, and yeah, there's some minimal disruption, but they basically say, you know, if you were kind of able to get back up and running within a couple of weeks. So as an example, I mean, we're maybe not a good example because we were also deemed an essential business, but the webinars that I've listened to is, you know, a lot of professional services kind of entities, businesses. It's going to be real hard for them to qualify because those are the kind of businesses that, yeah, it was work and it was painful, but you were able to basically convert to teleworking. So the position right now is that for a lot of those businesses, that doesn't qualify as a full or partial suspension. And so I think that's real helpful to sort of give you a sense. Like I said, it's for 2020, but to me that those provisions, it would be the same types of definitions. So there's a number of examples in there. So I would, if you're looking at that for your business, to me, that criteria is really kind of business specific. So you really have to look at, I mean, they also talked about like retail stores that, yeah, there were like some capacity limits and stuff, but sort of the answer on that was for a lot of retail businesses, probably not a partial or full suspension because you were able to continue operating. And a lot of the big retailers, I don't think for the most part, people could just come and go. I mean, there were smaller businesses that maybe had to hold people outside, but eventually those people got in. So to me, that's what that's useful for. I mean, if you can qualify under the gross receipts, then that's, you either need one or the other, and there will clearly be businesses that qualify under both, but that's kind of what I think that is helpful for. And again, like always, we're still waiting for some more guidance because there's still some unanswered questions, but it did give you a sense of sort of what they were thinking. So anything else, Beth, or are we kind of at our...
Nothing else coming in on my end here. Would you like to, or Steve, if you have anything else, otherwise you want to shift gears and talk about the date change for the deadline?
No, we can talk about the date change. Laurie, did you want to, or I can?
Yeah, it doesn't. Go ahead. You can start. I'll
Sure.
jump in if I want
You'll fill in for whatever I miss. So obviously, you know, the normal deadline for many things this time of year is April 15th. And because of all the stuff that we've got going on, thanks to our pandemic, well, the IRS just the other day came out and said, actually, I think yesterday, came out and said, well, we now have until May 17th for individuals who otherwise have returns due April 15th to file and pay. So you get, again, that basic 1 month for filing and paying. If you do want to do an extension, you simply have to have it done by May 17th to get until October 15th for individual return. Now, the extension, remember, is only an extension to file, not an extension to pay. Also keep in mind, this doesn't cover all that much as of right now. It's just individuals and balance due for federal individual returns. So what doesn't it cover? Well, it doesn't cover your first quarter estimated tax payments that might be due April 15th. It doesn't cover C corporations that are calendar year that are due April 15th. Doesn't cover calendar year trusts. Doesn't cover at the moment Minnesota or most states. There actually are a couple states that already hopped on before the IRS and extended their due date, but most have not. My guess is that most are probably going to match the federal as far as the states, but that remains to be seen. So in the next week or two, we expect to hear some activity and get further guidance in case it is expanded beyond the limited reprieve that we have right now. So, Laurie, what did I miss?
No, I think you covered most of it. I mean, I would just add that, the AICPA has already commented that it's not broad enough, because I think our disappointment was that, excuse me, for a lot of taxpayers, that first quarter estimate, you really need to finish the return. So it's not really helpful. I mean, the thought is that most of the taxpayers it's going to help probably already could have filed their return by that date. So I think that was disappointing. And the fact that it didn't cover anything other than individuals was disappointing. Yeah. And then Minnesota, who knows? I have a fear that Minnesota still might make you pay on April 15th, but we'll see. We don't know the answer to that yet. Minnesota, they've said they will have an answer fairly soon, but they're having to read the guidance, what IRS set out, which wasn't that much. So you'd think it wouldn't take that long, but it won't go quickly, probably. I'm mad at the IRS right now, so.
Sounds like.
You're not helping us.
Right. I guess one other thing I'll add is that everything is state specific and region specific to some extent. Texas, Oklahoma, and I think one other state that I can't remember right now already had until June 15th because of the flooding and other issues that they've had to deal with. So unfortunately, the problem is it's not an across the board deal. We might have a lot of specifics to look at, both state and entity type, to figure out when the real due date is this year.